There is a disconnect unfolding in the global silver market that deserves far more attention than the daily price chart. While many investors focus only on whether silver moved up or down by $1, a much more important signal is emerging behind the scenes. On one side of the world, buyers in China continue paying substantially more for physical silver than buyers in Western markets. On the other side, the warehouses supporting the world's largest paper silver exchange are changing in ways that reveal how the physical market is responding beneath the surface. These two developments are often discussed separately, but together they tell a far more important story. If you understand why these two markets are behaving differently, you'll understand why many analysts believe the real battle over silver is no longer being fought on price charts alone, but inside the global supply chain itself. Before connecting those pieces, it's important to establish where the market stands today. Precision matters far more than excitement, especially in a market where narratives often move faster than facts. Silver is currently trading near $62 per ounce, giving back roughly 1% during today's session after an exceptionally strong advance over the past year. Gold has also eased slightly, trading just above $4,150 per ounce following its historic move beyond the $4,000 milestone. Short-term pullbacks naturally attract attention because they happen in real time, but they often distract investors from the much larger trend that has been developing over several years. Stepping back changes the perspective completely. Over the past 12 months alone, silver has appreciated by more than 70%. Extend that timeline to roughly 2 decades, and the gain exceeds 400%. Those numbers are difficult to dismiss as temporary volatility or speculative excess. Instead, they suggest that silver has been undergoing a long-term structural repricing, one driven by forces that extend well beyond day-to-day trading activity. Against that backdrop, today's modest decline becomes relatively insignificant. Small corrections are inevitable during major advances, but they do not necessarily change the broader trajectory that has been unfolding underneath the market. Now consider something far more unusual than a 1% daily move. Although silver is trading near $62 in the major Western pricing hubs of New York and London, buyers using the Shanghai Gold Exchange are paying approximately $69 per ounce for essentially the same metal. That difference is not theoretical. It represents a premium approaching 12%, and it reflects actual transactions taking place between real buyers and sellers inside China's domestic market. More importantly, this is not an isolated event. During the past 6 months, the Shanghai premium has averaged above 12%, and during periods when physical supply became especially tight, it has expanded to nearly 34%. Temporary pricing gaps occasionally appear in commodity markets, but they usually disappear quickly because arbitrage traders move products from lower-priced markets into higher-priced ones. That process normally forces prices back into alignment. Yet that is precisely what has not happened here. Instead of disappearing, this premium has remained remarkably persistent. Week after week, month after month, Chinese buyers have continued paying considerably more than buyers in Western markets. When a spread like this refuses to close despite offering what appears to be an obvious profit opportunity, it usually signals that something deeper is preventing normal market forces from restoring equilibrium. Efficient markets depend on capital moving freely, products moving efficiently, and traders having unrestricted access to exploit pricing differences. When those conditions are absent, persistent premiums become possible. The reasons behind this continued divergence are rooted not in speculation, but in real-world market frictions. China's financial system operates under capital controls that limit how freely money can move across borders. Physical silver entering the country is also influenced by import licensing and quota systems, creating restrictions that prevent unlimited quantities of metal from flowing in simply because prices are higher. Add transportation constraints, logistics costs, and strong domestic demand, and the result is a premium that survives far longer than traditional economic theory might predict. Understanding that distinction is critical because many discussions stop at the word premium without explaining what it actually represents. A premium is not merely an expensive price tag. It is evidence that buyers value immediate access to physical metal enough to pay substantially above international spot prices. In other words, they are paying extra, not because silver itself suddenly became different, but because obtaining that silver inside their own market carries additional value. To appreciate why that matters, it's necessary to understand how the Shanghai market itself operates. Unlike many Western futures exchanges, the Shanghai Gold Exchange was designed around physical ownership and actual delivery. One of its important contracts, known as AGT+D, functions as a deferred settlement contract while still allowing participants to take delivery of real metal. That distinction changes the character of the marketplace. Whereas the overwhelming majority of futures contracts traded on COMEX are eventually closed financially without anyone taking possession of silver, Shanghai's system is far more closely connected to genuine physical demand. This difference cannot be overstated. On COMEX, fewer than 1% of contracts typically result in physical delivery. Most participants are traders managing financial exposure, rather than businesses seeking actual silver bars. In Shanghai, however, industrial manufacturers, jewelry producers, investment buyers, and other commercial participants are actively purchasing physical metal for immediate use or ownership. That means when Shanghai prices consistently exceed Western spot prices, the market is revealing something very specific. Chinese participants are demonstrating, through actual purchases, what they are willing to pay to secure physical silver today. They are not bidding higher for paper contracts or speculative positions. They are paying for tangible metal that can be delivered into their possession. There is another important detail that often receives little attention but significantly changes the economics of these transactions. The quoted Shanghai benchmark price is published before China's value-added tax is applied. Once physical silver is withdrawn from exchange warehouses, a 13% VAT becomes part of the buyer's total acquisition cost. That means the effective cost of obtaining physical silver inside China extends well beyond the already substantial headline premium. After accounting for taxes, buyers accepting delivery are paying meaningfully more than someone simply comparing exchange quotations might assume. This isn't an accounting curiosity. It demonstrates that purchasers are willingly absorbing both the premium and the additional tax burden because possessing physical metal itself is considered valuable enough to justify those higher costs. Viewed from that perspective, the premium becomes even more meaningful. It represents a market where participants continue placing significant value on immediate physical ownership despite additional expenses. Markets communicate priorities through prices, and in this case, buyers are clearly signaling that securing actual silver outweighs the added financial cost. Naturally, this raises an obvious question. If such a sizable pricing difference exists, why hasn't it disappeared through arbitrage? The answer lies in three structural characteristics that have shaped China's silver market for years. The first is the country's system of capital controls. Unlike fully liberalized financial systems, China places restrictions on the movement of capital across its borders. Those controls slow the ability of international traders to move money efficiently enough to exploit pricing discrepancies, reducing the speed with which arbitrage normally restores balance. Second, silver imports themselves are not unlimited. Import quotas overseen by the People's Bank of China regulate how much metal can enter the domestic market. Even if overseas suppliers are willing to sell at lower prices, those administrative limits prevent unlimited inflows from instantly satisfying local demand. The third factor may be the most strategically important of all. China is responsible for refining roughly 2/3 of the world's silver supply. In other words, the country already occupies a dominant position within the global silver processing chain. Yet despite holding that advantage, domestic buyers continue paying some of the highest premiums in the world to retain physical metal within their own market. That combination deserves careful attention. The nation processing most of the world's newly refined silver is simultaneously demonstrating unusually strong willingness to keep that metal at home. Rather than behaving like a passive participant accepting international prices, China increasingly appears to be strengthening its influence over physical silver itself. This doesn't automatically guarantee higher prices tomorrow, nor does it prove that shortages are imminent. But it does suggest that the physical market is operating according to dynamics that extend well beyond the daily fluctuations visible on financial screens. And once we shift our attention from Shanghai to the warehouses supporting the Western futures market, another equally important piece of the puzzle begins to emerge. To understand why the difference between East and West has become so significant, we have to leave the trading screen for a moment and examine the infrastructure supporting the global silver market. Price alone rarely tells the entire story. Behind every futures contract, every physical delivery, and every industrial purchase sits a network of vaults, inventories, warehouse receipts, and settlement mechanisms. Those systems rarely make headlines, yet they often provide the clearest picture of where genuine supply and demand are heading before prices fully reflect the change. The center of that discussion in the Western market is COMEX, the primary futures exchange where enormous volumes of silver contracts change hands every day. It's important to understand that COMEX is not simply a warehouse full of silver bars. It is primarily a financial marketplace where traders hedge risk, speculate on price movements, and manage exposure. Physical delivery is available, but it is not the objective for the overwhelming majority of participants. That distinction explains why the relationship between paper contracts and actual metal has become such an important metric for analysts who monitor the physical market. According to the latest available warehouse reports, COMEX currently holds approximately 93 million ounces of registered silver. Registered inventory refers to silver that has already been formally warranted and is immediately eligible to satisfy delivery obligations under futures contracts. Alongside that sits eligible inventory, which consists of metal stored inside approved vaults, but not yet designated for delivery. When those two categories are combined, total reported silver stocks stand at roughly 323 million ounces. At first glance, those figures may appear reassuring. After all, registered inventory has increased by nearly 10% over the past month. Anyone looking only at that headline could reasonably conclude that supply conditions are improving and that delivery pressure is easing. But the headline tells only part of the story. The more revealing question is not simply how much silver exists inside COMEX warehouses, but how much of that silver is available relative to the enormous number of financial claims built upon it. This is where the concept of the coverage ratio becomes essential. The coverage ratio measures how much registered inventory exists compared to outstanding paper obligations. Based on current data, registered silver is sufficient to cover only about 17% of those paper claims. Put another way, there are several ounces represented by futures contracts for every ounce that is immediately deliverable from registered inventory. That statistic often surprises newer investors because it sounds alarming at first. However, it is important to interpret it correctly. Futures markets have always operated with significant leverage. Most contracts are opened and closed financially long before delivery ever becomes necessary. Participants generally want price exposure rather than truckloads of silver. Nevertheless, the ratio still provides valuable information because it reflects the relationship between financial claims and immediately deliverable metal. Even if delivery demand remains relatively small, a declining coverage ratio signals that the cushion supporting the physical settlement process is becoming thinner. Independent researchers who monitor these dynamics through various physical stress models currently place COMEX's physical stress indicator in the low 30s on a 100-point scale. That reading suggests meaningful tightness, but falls short of the most extreme levels observed during previous periods of market stress. Likewise, estimates of paper leverage indicate that roughly $5.50 worth of financial claims currently circulate for every dollar of registered silver available for delivery. Again, this does not imply that the system is broken or that every contract holder will suddenly request physical metal. Instead, it illustrates how heavily modern futures markets rely on the assumption that most participants will continue settling positions financially rather than demanding delivery. The more interesting development lies in how registered inventories have recently increased. Over the past several weeks, registered silver has climbed from roughly 82 million ounces back toward the low 90 million ounce range. On the surface, that appears to indicate fresh supply entering the market, but a closer examination reveals something quite different. The increase has not primarily come from newly mined silver arriving at COMEX vaults. Instead, much of the additional registered inventory has resulted from metal already sitting inside those same warehouses being reclassified. This distinction matters. Eligible silver and registered silver often occupy the exact same vaults. The physical bars themselves do not move. The difference lies in their legal status. Eligible metal belongs to owners who have not designated it for futures delivery. Registered metal, by contrast, carries the necessary warrant, allowing it to satisfy delivery obligations immediately. When eligible inventory is converted into registered inventory, no new silver is created. The same bars remain inside the warehouse. What changes is the owner's decision to make those bars available for potential delivery. That seemingly administrative adjustment can reveal a great deal about market conditions. Owners generally do not convert eligible silver into registered status without reason. Making metal deliverable increases flexibility, allowing warehouse holders or owners to respond more easily if delivery demand rises or market conditions change. While such reclassifications occur regularly over time, periods of increased conversion often coincide with environments where maintaining optionality becomes more valuable. In other words, someone who already owns physical silver inside the vault has decided that having those bars immediately available for delivery now provides greater strategic value than keeping them inactive. That decision does not necessarily indicate stress. It also does not prove that shortages are imminent. But it does suggest that participants responsible for substantial quantities of physical silver are actively positioning themselves to respond to evolving market conditions. Now consider what we've already learned from Shanghai. Chinese buyers continue paying premiums that have remained elevated for months, despite obvious arbitrage incentives. Those premiums reflect genuine demand for physical metal. Meanwhile, COMEX has increased deliverable inventory primarily by changing the status of silver already sitting inside warehouses, rather than through a major influx of newly produced supply. These developments are not contradictory. In fact, they fit together surprisingly well. One market is demonstrating sustained willingness to pay more for immediate ownership. The other is improving delivery flexibility by redesignating existing inventory instead of relying on significant new physical inflows. When viewed together, they describe two markets adapting to the same underlying reality from different directions. This becomes even clearer when comparing the broader structure of both systems side by side. In China, physical buyers continue accepting premiums of roughly 11 to 12% above international spot prices to secure silver now, rather than later. These premiums have persisted for months and, during periods of tighter supply, have expanded beyond 30%. Meanwhile, in the United States, registered COMEX inventories have improved numerically, yet much of that improvement reflects internal warehouse reclassification rather than substantial increases in freshly mined metal entering the system. At the same time, paper obligations continue exceeding immediately deliverable inventory by a significant multiple. Neither observation invalidates the other. Instead, they describe different layers of the same market. One measures what buyers are willing to pay for immediate physical possession. The other measures how the world's largest futures exchange manages deliverable inventory against outstanding financial contracts. Historical data reinforces why this comparison deserves attention. The relationship between Shanghai premiums and COMEX inventories is not unique to the current environment. Similar patterns have appeared repeatedly whenever Chinese physical demand accelerated or registered inventories within Western exchanges declined. During previous periods of particularly tight physical conditions, Shanghai premiums expanded dramatically, at times exceeding 30% above Western benchmark prices. Those episodes demonstrated that the physical market could become significantly more expensive than paper quotations without immediately forcing convergence between the two pricing systems. That history matters because it reminds investors that persistent regional premiums are not statistical accidents. They tend to emerge when physical supply becomes more valuable relative to financial pricing mechanisms. Seen through that lens, today's market appears less mysterious. A premium that refuses to disappear in one of the world's largest consuming markets, combined with a Western exchange where deliverable inventory covers less than 1/5 of outstanding paper claims, points toward an increasingly competitive physical marketplace rather than a malfunctioning financial system. This does not imply that futures prices are false or that COMEX cannot continue functioning normally. Futures markets are designed around financial settlement, and they have operated successfully with leverage for decades, but it does suggest that the physical side of the silver market may be considerably tighter than someone would conclude by watching only short-term price movements. Price charts capture transactions, warehouse reports reveal inventories, premiums expose urgency. Together, they offer a much richer understanding of what is actually happening beneath the surface. And beneath all of these developments lies an even larger force, one that has been quietly reshaping the silver market year after year, regardless of daily volatility, central bank meetings, or currency fluctuations. To fully understand why both Shanghai's premium and COMEX's inventory dynamics continue attracting attention, we need to examine the long-running structural supply deficit that has been influencing the global silver market for years. To understand why these signals continue appearing across different parts of the world, we have to look beyond exchange inventories and regional premiums and examine the broader balance between global supply and demand. Neither Shanghai's persistent premium nor COMEX's warehouse dynamics developed in isolation. They are occurring against the backdrop of a market that has quietly been consuming more silver than it has consistently been producing for years. According to the Silver Institute's most recent comprehensive annual market survey, the global silver market remains on track for its 6th consecutive annual supply deficit. That statistic alone is significant because sustained deficits are uncommon in commodity markets over such an extended period. They suggest that above-ground inventories are gradually being relied upon to bridge the gap between what the world consumes and what mines and recycling operations are able to provide. What makes this deficit even more noteworthy is the reason it has continued, despite one of the market's most widely anticipated efficiency improvements. For years, one of the principal bearish arguments against silver centered on the solar industry. As photovoltaic technology advanced, manufacturers steadily reduced the amount of silver required in each individual solar panel. The logic appeared straightforward. If every panel used less silver, then demand from one of the metal's fastest-growing industries should eventually begin easing. The efficiency gains did in fact materialize. Solar manufacturers successfully reduced silver consumption per panel through technological improvements and more efficient production methods. Under normal circumstances, that development would have been expected to relieve pressure on overall demand, yet the opposite occurred. Despite requiring less silver for each individual panel, the overall market deficit continued widening instead of narrowing. That outcome reveals something extremely important about the broader demand picture. Growth across other sectors has been more than sufficient to offset those efficiency improvements. Expanding production of electric vehicles, increasingly sophisticated electronics, advanced industrial applications, and numerous high-technology manufacturing processes have continued absorbing substantial quantities of silver. Rather than depending on one single source of demand, the metal has become increasingly integrated into multiple industries that continue expanding simultaneously. At the same time, supply has proven far less flexible than many investors assume. Unlike gold, a large percentage of global silver production does not come from mines dedicated exclusively to silver extraction. Instead, much of the world's silver is produced as a byproduct of mining operations focused primarily on copper, lead, and zinc. That distinction has enormous implications for future supply. If demand for silver suddenly increases, mining companies cannot simply decide to produce dramatically more silver next month. Production decisions are largely determined by the economics of the primary metals being extracted. Unless copper, lead, or zinc production also expands, silver output often remains constrained regardless of how attractive silver prices become. This structural characteristic limits how quickly the industry can respond to sustained demand growth. As a result, annual deficits cannot necessarily be eliminated through a rapid increase in mine production. Instead, inventories accumulated over previous years gradually become more important in balancing the market. This is why long-term structural trends deserve at least as much attention as daily headlines. Individual events certainly influence short-term prices. Employment reports, inflation data, central bank announcements, currency movements, and geopolitical developments can all generate significant volatility over days or weeks. But structural supply deficits operate on an entirely different timescale. They quietly influence inventory levels year after year, gradually altering the balance between available metal and future demand. They rarely dominate financial news cycles because they unfold slowly, yet their cumulative impact can eventually become far more important than any single trading session. When viewed through this broader framework, both the Shanghai Premium and COMEX warehouse activity begin making much more sense. Chinese buyers paying elevated premiums are participating in a market where physical metal continues commanding additional value. COMEX warehouse owners reclassifying eligible inventory into registered status are improving delivery flexibility within a future system built upon financial contracts. Neither development alone proves that a dramatic event is imminent. Together, however, they reflect a marketplace adapting to persistent underlying tightness. That said, maintaining perspective is essential. Financial markets often reward balanced analysis more than dramatic predictions, and silver is no exception. Although registered COMEX inventory has increased largely through internal reclassification, the result is still more immediately deliverable silver than existed several weeks ago. Regardless of how those additional registered ounces were created, they expand the quantity of metal currently available to satisfy delivery obligations. That represents a genuine easing compared with the tightest inventory conditions observed earlier. Similarly, Shanghai premiums have narrowed before. History shows that elevated premiums can retreat relatively quickly when domestic demand slows or when Chinese authorities adjust import quotas. A premium that persists today should not automatically be interpreted as permanent. Markets evolve continuously, and regional pricing differences can change as supply conditions improve. The same balanced perspective applies to COMEX coverage ratios. A coverage ratio in the high teen percentage range certainly reflects tighter physical conditions than periods with substantially larger inventories. However, comparable levels have occurred previously without producing delivery failures or disrupting the normal operation of the exchange. It is equally important to remember that substantial paper leverage is a defining characteristic of futures markets themselves. The overwhelming majority of futures participants never intend to take delivery of physical silver. Producers hedge future output. Industrial consumers hedge purchasing costs. Investment funds speculate on price movements. Traders provide liquidity. Because so many contracts are eventually closed financially, futures exchanges have historically functioned with paper claims that greatly exceed immediately deliverable inventory. Therefore, high leverage alone should not automatically be interpreted as evidence that the system is approaching collapse. Instead, these indicators should be viewed as measurements of current market conditions rather than predictions of future outcomes. Physical inventories can remain under pressure for extended periods. Premiums can persist longer than many expect. Warehouse classifications can continue evolving as owners adjust their strategies. Markets often remain in states of tension without reaching dramatic breaking points. That distinction is critical because it separates objective analysis from sensationalism. The purpose of examining warehouse reports, delivery ratios, and regional premiums is not to forecast an inevitable shortage. It is to understand how the physical infrastructure supporting the silver market is functioning at this particular moment. When all of these observations are brought together, a coherent picture begins to emerge. China's market is signaling what buyers are currently willing to pay to obtain physical silver inside one of the world's largest consuming economies. That signal is reinforced by a premium that has remained elevated for months and, during previous periods of tighter supply, expanded substantially further. COMEX, meanwhile, provides a different perspective. Its warehouse reports reveal how much silver is immediately available for delivery against an extensive network of futures contracts. Recent increases in registered inventory improve delivery capacity, yet much of that improvement reflects the conversion of existing eligible metal rather than the arrival of significant new mine supply. These are not conflicting realities, they are complementary views of the same global market. One reflects immediate physical demand. The other reflects the mechanics of the world's largest financial trading venue for silver. The difference between those two perspectives is precisely what deserves continued monitoring. If Shanghai's premium begins expanding again while COMEX coverage ratios tighten further, the relationship between physical demand and financial inventories may become even more informative. Conversely, if Chinese premiums narrow substantially while registered inventories continue improving, that could indicate easing pressure within portions of the physical market. Neither outcome should be viewed in isolation. The real value lies in watching how these indicators evolve together. Markets rarely communicate through a single statistic. Instead, they reveal their underlying condition through the interaction of multiple independent signals. Premiums, inventories, warehouse classifications, coverage ratios, industrial demand, and structural supply trends each provide one piece of a much larger puzzle. Viewed individually, each metric tells only part of the story. Viewed collectively, they offer a far more complete understanding of how the silver market is changing beneath the surface. Ultimately, the most important takeaway is not that one exchange is right and the other is wrong. It is that each market is measuring a different aspect of reality. Shanghai reflects the price buyers are prepared to pay for physical ownership today. COMEX reflects the quantity of deliverable metal supporting an active futures market built upon financial participation. Both sets of information are genuine. Both deserve attention, and the widening conversation between those two markets may prove far more meaningful than the next 1% move on a daily price chart. As the next series of COMEX warehouse reports is released, and the following Shanghai price fixings become available, those developments will continue offering valuable clues about whether physical demand is strengthening, stabilizing, or beginning to ease. For investors who want to understand where the silver market may be heading over the longer term, following that evolving relationship is likely to provide a much clearer perspective than focusing exclusively on short-term price fluctuations. In markets driven by both financial trading and physical demand, the most revealing signals often come not from the headlines, but from the quiet shifts taking place inside the vaults that keep the entire system moving.